We're dealing at the same exact moment in time with a whole variety of activities in markets that actually go against one another in certain ways and have different and varying impacts over different time periods. We're going to talk about what's going on in Washington, D.C.
First off, what we're seeing and the expectation that's building is a passage of a bill of tax increases and spending increases. The probability of a very large corporate tax hike is going down. The probability of a small tax hike is going up.
Central banks are obviously withdrawing support for market as COVID abates.
Perhaps before the end of the year, we will see the incremental quantitative easing diminish. This is setting the groundwork for a year from now for a first rate hike.
You're reading every day about the fact that there are bottlenecks everywhere and that supply chain issues are at fault and that there are going to be supply issues in perpetuity causing inflation in perpetuity.
When there's some emergency demand to fill storage, you get a crisis price. And that price rarely lasts for very long. It tends to be a very, very stable price for a long period of time, spikes to extraordinary high levels, and drops very fast. These things, these bottlenecks, shortages, are not really indicative of the long-term pattern of growth.
China faces a real economic slowdown due to policy changes, events in the marketplace, and then extraordinary government events, including their focus on their own real estate markets.
What we have seen has been a very deliberate attempt to wring the excesses out of the property market. I think the slogan is property and housing is for living, not investing. And the overall level at which property finance has been restricted is going to have a severe hard landing impact. I would look at this as a true economic slump in China. It is reversible, but we have yet to see that happen.
All of these things portend a slower rate of growth in the future, and again, less pressure on interest rates, and ultimately, of course, an equalization or an equilibrium reach in markets itself.
With COVID disappearing, some services activity will pick up and durable goods spending will come down.
This is the concept of normalization, of spending for services, including leisure, rising back to normal rates, of spending on durable goods coming down, going back to normal but positive growth rates. And as a result of that, right, you will actually see equilibrium reach sometime in 2022, we believe. The fact that the economy is, in fact, normalizing allows us to make the statement that we're reminding you that the growth rate of around 3% that existed prior to the pandemic is a sustainable and slower growth rate than we've seen during it. And so that return to normal is exactly what we're going through, but at a very, very slow pace with a very, very distorted economy due to the pandemic itself, which is pretty evident to everyone.
This is, again, the way things work. When you start to have private income growth, replace stimulus, you're in a more sustainable place. Growth is a very normal state, but certainly not, at the speed that we were from rebounding from COVID.